are you guys invested in data centers?
So first, look, there will be winners and losers in data centers.
Yep.
And we study the space incredibly closely. What we're seeing, though, is data centers have a lot of components. So first of all, in our portfolio, the average industrial site is roughly $200 per square foot. Data centers, $500.
Wow.
So 2/3 of a data center is actually the power, the technology, and everything that goes along with the data center, not the real estate. So for us, we've gone more pure play real estate, but we do see technology in other places like manufacturing, and we're buying a lot of industrial focused on robotics, manufacturing, and how do you make goods cheaper and faster all around the United States.
Which maybe the data center will use those things then in its production. So when you say pure play real estate, what does that mean?
So we love housing. We talked about it last time we were here. We think there's a structural just demand for housing. Over 5 million housing units are what we're going to need to satisfy the demand in the United States. So we're seeing residential rents continue to grow. Additionally, everyone talks about industrial, but what they miss is what's actually happening with the CHIPS Act. So if you look at the CHIPS Act, there's over $1 trillion of investment in California, Arizona, Texas, and New York, all driven towards manufacturing. So just to give you an example, we have a site in Torrance, California. And it's really hard to find manufacturing talent. So what happens? You have to use robotics for efficiency. And we have 4,000 amps of power in our site. A traditional industrial site is 500. So it's a big trend and something that people should be focused on.
What's the growth rate look like long term, particularly when it comes to manufacturing of robotics and other kind of high-tech areas similar to that?
It's huge.
Yeah.
So as you know, American exceptionalism is something that's happening. The new administration is very focused on things made in the United States. Manufacturing demand is at all-time highs. I think there's a recent survey from Deloitte that said you need 3 million more workers just in manufacturing to meet demand.
Yeah.
So for us, we're focused on everything from supply chain to the actual manufacturing facilities.
How do you determine, though, geographically, where to make that investment when it comes to robotics and all these things, particularly if there aren't as many humans involved? What's the decision process?
Again, a lot of times you follow the dollars. So most people are talking about investment, but they aren't talking about the Inflation Reduction Act or the CHIPS Act. Again, Texas, Florida, Arizona, the Sun Belt, New York, those are places that have capital. And what you're seeing is investment come out of that for makers of technology in addition to other manufacturing goods.
Does any of that change if the back end of the bond market yields stay high?
Higher for longer, that's what everyone's saying. I think a couple things happen. So one, obviously our cost of capital is higher, but that also means home affordability is just much more difficult. So if you look at it now, the parity between owning or renting, it's 50% cheaper to own a home today, or it's 50% cheaper to rent a home today than to own. Which is the highest it's ever been. So if rates stay higher for longer, that imbalance will continue.
Oh, Romaine, sorry. Yeah. He's renting and looking for a house. That's the last thing you wanted to hear. Another trend that we tend to talk a lot about is senior living and student housing, and those two being some, good trends, never going to go away in the industry. Do you agree with that?
We love it. So we look.
Oh, you do? Okay.
We look at both student and senior. The demographic trends just say it's a great place for rent growth. I think really, though, the main focus here is picking the right partners. So what's nice is we've got a lot of partners that we've dealt with over years, and we're able to really focus on the right assets in the right markets.
So when we get back to this idea of finding these opportunities and the competition for them, I am curious what that looks like. I mean, you started off with that great anecdote about the differential that you're seeing in square footage prices for data centers, because obviously everybody's going in that direction. But some of the other areas that you are invested in are also, there's no secret that these are hot areas, at least from a long-term trend perspective.
Look, it's frothy.
Yeah.
One of the advantages we have, though, is 1 out of every 2 Americans are JPMorgan clients. So we've got data on where people are going, migration trends, investment, household formation.
Yeah.
It's been huge for us. I think the other thing is we've been around for over 60 years. So not only do we have macro themes that we work on top of house, but we also are on the ground in these markets every single day. And we've got an $80 billion portfolio around the world and over 10,000 clients across the bank.
I do have to ask you, though, about the political side of all this. I mean, when we talk about macro themes, you can't really talk about that without talking about what's going on in Washington. You mentioned the CHIPS Act and the IRA. You have an administration that is pushing policies, in some cases, that would roll back some of those provisions from previous administrations. So how do you model, without getting too deep into politics, how do you model for the uncertainty of Washington policy right now that is short-term in nature, but could have long-term impact on your market?
It's a great question. We're long-term investors. So first, we model every outcome, but we look at the fundamentals. That's what's great about real estate, which is cash flow. How do we create returns for our investors, and how do we do it using our unique advantages? One of them is just supply demand. So we know we need 5 million houses in the United States just to meet demand. It's undersupplied, will continue to be. I think secondly, we just look for fundamental shifts and imbalances. We look for the most fragmentation, and that's where we go and find value. For example, looking at industrial, but looking at it slightly differently. Who's manufacturing? Why are they manufacturing? How do they do it using technology versus just a big warehouse in the middle of nowhere?
But to Romaine's point, I'm assuming you're staying away from anything that may have to do with production tax credits or other tax credits, right, that could go away. I'm just thinking of solar. Like, if you had bet on sort of a solar farm or some kind of property with solar, that's out the window now.
Look, it depends. So we do look at solar, we do look at ESG, but a lot of times it's got two benefits. So yes, it's good for the environment, but it also lowers costs, which drives return for our investors. And typically it's a two-sided investment. One, are we doing the right thing for communities, which we always will? But two, how does it drive great returns for investors over the long term?